Our focus is value creation. When I say value creation, I mean value per share creation of everything that we do.
A lot of companies are saying the same things as you. People got to try and understand why you versus the next guy.
Not a lot of companies, exploration companies, are going to say that they've had 61 million shares outstanding for 2 years. It just doesn't happen very frequently.
Yeah, but that's not how I make money. I make money when your share price goes up, right? And it hasn't.
I can push all I want, but if the market is not ready from a timing perspective to go up, the best thing I can do from an investor is protect the capital, protect the share structure, because when it turns, Allegiant may actually be the best company positioned from a price per share perspective.
Hello and welcome to Crux Investor. First of all, thank you so much for watching this video. If you like it, give us a thumbs up and do leave your comments below. It helps us understand what questions and thought processes that you're going through, and we do try to get back to everyone. And if you haven't already done so, please click the subscription button in the corner of the screen. And for more videos like this, click the notification bell. We spoke today to Peter Gianulis, who is the CEO and president of Allegiant. They're a Nevada gold explorer. They've got 9 projects. Their key project for them is the Eastside project, which they're trying to develop and understand. They've got the Bolo project, which they have farmed out and has delivered some income to them. They've got about $500,000 of cash, and in the current climate, raising finance is tough for exploration companies, so sometimes the best thing to do is sit and wait. We discussed with Peter his options, strategies, and his vision going forward. If you want to take a look at some of the other topics discussed, look in the description below. You can click on the relevant timestamp, and that'll take you to that part of the video. Otherwise, let's hear what Peter had to say. Hello, Peter. How are you, sir?
Hi, Matt. How are you? Doing well, thank you.
You're on lockdown in Miami. There's worse places, right?
There's a lot worse places. It's about 25 degrees centigrade outside. Sun's shining. It's beautiful.
You got the family there. Can't be bad.
It's great.
Can't be bad.
It's amazing.
So you're going to tell us about Allegiant today. So why don't you kick off with a 1-minute summary and we'll pick it up from there.
Well, I can give you a 30-second or a 2-minute. I don't have.
Oh, give me a 2-minute. Give me a 2-minute. We'll be generous. We've got time.
Okay, great. Well, Allegiant Gold is a gold exploration company with 9 projects in the southwest of the United States, with the primary focus being on Eastside, which is our 1.1 million ounce flagship project located about 40 to 45 kilometers northwest of Tonopah, Nevada, a town that's well recognized, as well as Bolo, which is another gold discovery we made in 2016, which is currently being drilled and developed by Varian Mining, which is our earn-in partner. I think it's important to mention a little bit about our philosophy and how we look at Allegiant and how we manage it as a group. I kind of boil it down into 5 things. First thing being focus. We do have 9 projects. Exploration is a very risky business. Our belief is if you have something like we do with Eastside, then focus on it. Focus all your energy, all your capital on developing that, and then farming out the rest. And farming out the rest to earn, work programs as well as cash coming in the door. The second philosophy is keeping a low G&A and cash burn on the company. Henceforth, you don't have to raise money just to keep the lights on and paying G&A, and farming out projects actually helps with that. The third philosophy we have is the concept of accretive dilution. Markets are volatile, they're cycle dependent, and there's no more than that than, say, the exploration and the gold exploration industry. Sometimes, and it's a little more controversial to say that, but sometimes it's actually better to do nothing. And we do have the luxury today of doing that because we don't have to raise, in theory, have to raise capital to keep the lights on. We can't advance our projects unless we raise capital, but we'll let the markets determine that. The fourth thing is jurisdiction. I've spent the last 25 years working in Latin America, either investing in it or working with companies there. Some amazing gold and precious metal and other resource projects out there. I do have a saying that I developed, Matt, over the last 25 years about Latin America and some of the fringe emerging markets is it's a kind of a lose-lose proposition. And it goes back to jurisdiction. In Latin America, if you're working on a project, find it and you find nothing, well, you lose. But if you're also working on a project and you find something amazing, you also lose because they'll find a way to take something away from you. And I've seen that many, many times. And then the fifth of our philosophy is really having skin in the game, having management buying shares, having management have a large ownership position, and management and insiders having that position in the company. And I think at Allegiant, we've proven that over the last 6 months of large insider buying of our own company. That's a 2-minute kind of summary.
Thank you very much. I appreciate that. So, and how long have you been at the helm as CEO and president?
I've been at the helm since early October, so about almost 6 months now. Prior to taking over the role, I've been at Allegiant on the board of directors for, depending on how you count it, for about 11 to 12 years. Allegiant, prior to spinning out, prior to being an independent company, was part of Columbus Gold. And the reality, if you go back to the history of Columbus Gold, Columbus Gold was Allegiant from 2006 to about 2011, and then Columbus went off on another strategy of becoming a developer, and they have an amazing asset in French Guiana. So I have been involved with Allegiant directly in basically acquiring almost every single asset they have today over the last 11 years. Okay,
so, but at the helm since October, so 6-7 months, because I'm looking at the share price, and if I'm a shareholder, I'm not happy. I'm not happy for the last 3 years. I know you had a bit of a comeback rally over Christmas. This Christmas just gone, but it's popped back down again. So, what I want to get at today's conversation with you is an understanding of what direction the company's going in and how it's going to create shareholder value, because right now the shareholders aren't making money. The company might be with the various projects that you've been doing. So if you don't mind sharing with us, let's kick off. What's the business plan? How would you describe yourself, first of all? What is the company so people get an understanding of what the risk profile of the company is, and what are you planning to do? You've talked about one of your 9 projects. I guess it's a start, but let's talk about the business plan first.
The business plan, I'll talk about the business plan. We can address the stock a little bit later, because that's a completely different conversation. So on the business plan is to focus on Eastside. Our belief is that we have an emerging district size opportunity. Eastside's about 72 square kilometers. It was discovered, we've had it for about 10 years. We discovered the first results 4 or 5 years ago, and we focused on drilling. We have over 60,000 meters now drilled at Eastside on an original pit zone. So I want to set the framework for to answer your question. The original pit zone initially had 700,000 ounces at about 0.6 grams a ton. We've now incorporated additional drilling, obviously, to be fair, higher gold prices, which now led to about a 1.1 million ounce resource deposit, same grade, 0.6 grams a ton. Our entire business plan now is focused on Eastside, in increasing the size of that resource, reducing strip ratio, and finding additional deposits within the Eastside district. So today, Eastside has 1.1 million in the north part, which is the original pit zone. And then we have an additional 270,000 ounces on the south part of the project. So if you look at it, there's really about 15 kilometers, 20 kilometers difference between the north and the south. They're not connected. We have about 270,000 ounces of historical resources on the south zone. So combined, which you shouldn't do, because one's 43-101 compliant, one is not, you get an idea of the size of this deposit. It is growing. There's a lot of potential to continue to develop that. So our business plan is focused on increasing the size, reducing strip, going at depth. It's open literally, and I hate to say this because I've been on both sides, it's open in all directions. And, I've never been in a pitch where they said it's not open in all directions, it's not open in all directions, but it's open on the northwest, south, and east, and at depth. And so there is a lot more work that's required. Reducing strip is important. There's a path to reducing strip. We've done our own internal PEA. And ultimately, over the next 2 to 3 years, and it could be shorter or it could be longer depending on market conditions, we would continue to drill new targets in there, and focus on Eastside to get to a published PEA.
Right. So your model is, you are an explorer. You're building out ounces. That's what you want to do. You want to build it out to a point where you're attractive to someone who steps in and then builds a mine. Is that, or adds ounces to their resource number? I mean, is that what you are?
I think that there's two paths here. I think there's that path which you just stated, which is fair. There's not a lot of 1 million ounce oxide type resources in a jurisdiction like Nevada that's not owned by Kinross or Nevada Barrick. We are very close. I can actually see Round Mountain from Eastside. It's about 30 miles. If you want to talk about miles, it's actually on a clear day, I can see it. There's not a lot of those resources out there. There are sulfide refractory deposits out that are 3, 4, 5 million, but require toll milling, and that just automatically renders it not economical. The second path is finding, and we won't talk about this because we haven't discussed it publicly, but the theory of having a higher grade zone within Eastside to start a starter pit, which changes the dynamics of what we would potentially do. So if you can find that area of, call it 200,000, 300,000, 400,000 ounces of a starter pit, which is higher grade, it allows you to it gives you another option on how you would like to develop Eastside in the event that Allegiant were to go down that route. And I'm not saying.
But that's a tough one, and a lot of people talk about being able to do that, and with low grade, that's tough. So it would have to be significantly higher grade than you are currently experiencing, but you've done an internal PEA, so you've got some sense, albeit a very basic economic sense of what the potential is there. So are you able to say that is something that you're still seriously considering?
I mean, I wouldn't say it's a basic PEA. I mean, there's a lot of work that went into it. We do have, if you look at our board of directors and you look at our chief geologists, these are people that are I'm not saying that you can just look them up. They're some of the most well-respected people in the industry. The ex-president of El Dorado, that's $1 billion company. Andy Wallace is, I think, arguably or unarguably probably the most respected geologist in Nevada. These are people who understand that, MDA is our resource consultant. I've had people look at our internal PEA, and so we have, I would say it's a little bit more than just some back of the napkin numbers. So to answer your question, the PEA absolutely shows our internal PEA, potentially shows a robust resource there. It is very sensitive to the price of gold because of the strip ratio, and that's something that we need to, if you ask me it's not all beautiful. I mean, Eastside is an amazing project, but we have to reduce the strip ratio, and there's a path to reducing that strip.
Right. Okay.
Building additional with that.
Okay, I understand. But you get my point. Like a regular PEA has a plus or 30% variable there. It's preliminary, clues in the description. Your process that you've gone through internally surely wouldn't have been as robust as a regular PEA because you're not going to spend the time or money on it. What you do have is years of Nevada-based experience, and obviously with Andy Wallace, etc. I guess there's a lot of peer data that you can use. But what I'm interested in is in getting back to my original question, which is what type of company are you? If you're going to go down the route of building out ounces and be taken over, I'd love to have the conversation with where the value lies for shareholders there. What's the value you can create? And we've seen companies do it, but I want to know how you're going to do it. Or if option 2 is a reality, you've some ways to go. At some point, you're going to have to, do those studies and work out what the economics are before anyone's going to step in with a bunch of cash for you, aren't they? So these are the things going around in your head. So how do you move this forward? How do shareholders understand what it is that you're trying to build out here?
Yeah, I mean, from a shareholder perspective, I'm interested in what the value per share is. I'm not interested in the market cap of a company. Like it does no good to a shareholder me taking a company from 10 million in market cap to 100 million, but the share count goes from 60 million to 1 billion.
There you go.
Yeah, I've been in that situation many times. So I am very, very focused on what the value per share is, not the value. Like I don't care. Building $100 million company is not that difficult. Building a $5 per share company is extremely difficult. Okay. So our focus on that is value creation. When I say value creation, I mean value per share creation of everything that we do today, given the current market scenario for junior exploration companies. I mean, gold can be at 1,700. I mean, you can look at the GDXJ, which isn't really a junior mining index. It's actually a mid cap type of mining index. But if you look at a collection of the exploration companies, they really haven't participated. What we decided to do with our cash is prepare ourselves to expand the resource and do things that are probably that I couldn't do in parallel and are probably the most time constrained aspects, which is permitting. And so what we decided to use this time and our capital to get ready for drilling, because if the markets turn and I haven't done the permit, now I'm going to waste a year. So now what we've done is we started the permitting, we started the studies to expand our operating permit zone from 250 hectares, 600 acres to 3,600 acres or 1,500 hectares essentially, 1,600 hectares, where we can now be ready when the markets turn. We raise capital in the event that that's what the market wants us to do or we want to do, to test additional targets and expand our operating zone. We believe that will add value per share more than anything else we do.
Right. How much cash have you got today?
Well, cash and marketable securities, because I think it's important, both of them, and I can get into that, why I think it's important, would be, $500,000 to $600,000.
Right. Okay. So to do anything meaningful, you're going to have to go back out to market. And I guess I'm going to keep pushing you here because I want to get the answer, which is a lot of companies are saying the same things as you. And if you're going out to market at the same time as them, people got to try and understand why you versus the next guy. Okay. So what is that thing? It comes down to that elevator pitch here. Why you versus the next guy saying exactly the same thing?
Yeah, I think there's great companies, and I think each investor has to understand where they want to be in the risk spectrum. So you have pure exploration companies that are trying to find that next discovery. We're beyond that. We do have a resource. It is in a great jurisdiction. It has, early stage metallurgy is great. We have a nice 1.1 million to build on, and there's not a lot of companies that can say that. And our risk profile, obviously, as an exploration company, is risky, but maybe less riskier than a company that's looking to find something, or even just drilling and finding gold isn't that difficult. Finding an economic deposit is actually very difficult.
Right. So given your bulk operation, what size of resource are you going to need to get to be interesting to someone like an Equinox or those sorts of guys who are good at doing what this project will need doing. So what's that number? Is it 5 million ounces? Is it 6 million? Is it 10? I mean, what happens?
I don't think it's that linear. I don't think it's a linear function of how many ounces you get. I think there's a lot of combination of what grade, I think metallurgy, I think strip ratio, I think the gold price plays an important part. And at 1550, I can tell you ourselves and many other projects are extremely economical. But that, it's not what I'm saying. It's that the majors or mid tiers need to feel comfortable that gold will be 1550 or 1600 or 1650 over periods of time. Clearly, we're extremely, we haven't published anything, but I would think we're very, very profitable economic if we use 1550 gold. So I think one, it's a factor of that. Two, it's a factor of size too. And I think three, in our case, more than size, improving up 3 to 5 million ounces, which I think is absolutely something that could occur at Eastside. But I think more relevant today for us is showing that we have a path to just reducing strip from say 6 to 4, because even at 1550, 6 strip, we're very profitable.
Everyone's profitable at 1550.
Yeah, that's my point. My point is strip ratio increases the sensitivity to gold prices, right? So if we can reduce the curve from 6 to 4, then it becomes less sensitive to gold prices. And the way we go from 6 to 4 or 5 or whatever that number, each incremental one drop by 1 of strip ratio is significant. And so our path is to expand it, continue finding gold along the outer part of that shell, which we know exists, and going at depth, because that will also reduce strip as well, where we what we see on the geology of what we have. So we have 170 holes. We know the geology fairly well, and I think that there is that path. It just requires we know what we know, but since we're a publicly traded company and there's an NI 43-101, and an updated resource estimate, we need to show the market, that information on a public basis.
Right. So when do you start that process? There are, traditional reports which people expect to see to give them comfort around what it is that you've got. When are you going to start that process? With $500,000 in the bank, that's going to get you so far. I don't know what your burn rate is on a monthly basis. I know you guys have put some money in here, but what is your overhead?
Our overhead in US dollars, because I kind of think of US dollars as opposed to Canadian dollars, is about, not including land holding costs, but just pubco costs and salaries and everything, is about $30,000, $35,000 a month.
Okay, so it's not crazy. Okay, so you've got enough money to see you through, let's say, and for 12 months. Would that be fair if you did nothing?
Yeah,
right.
Well, yeah,
but you've got to do something.
Well, I mean, but there's another element that I think is important. I mean, we are getting constant cash payments, right? So it's, what do we have in cash and what do we have coming in the till every year, right? And so we do get about $550,000 US dollars every year, more or less. So yes, we have money, we have marketable securities, and we get paid every year on our farm outs. So it's not just how long the cash lasts us, it's, well, how much money's coming in too.
Okay, so are they paid annually or quarterly, or how do the...
Annually in different periods of time, but yes, annually. So our next payment in certain ones will come in later this year, and then at the end of this year, we'll have another payment.
Okay, but those dollars themselves right now are just helping kind of run the company. They're not creating value, dollar for dollar. You're not doing much with that money at the moment, are you?
Well, we are. I mean, it costs money to permit. There's studies you have to do. There's geological work you have to do. So what is it paying for? Well, it's paying for getting the operating permit area expanded. It's paying for geological studies, sampling, geochem, geophysics work. I mean, there is a lot of things that go into prepping. You just, just blindly throwing the hole down. We need to reduce the probability of increase the probability of finding something, and that requires a lot of groundwork that we're doing, and we're funded for that. And then if we want to do a 5,000 meter program, each meter today drilled is about $110 US. So that kind of gives you a number of 5,000 meters would be what's $600,000 essentially. Then you have some road building, you have some additional bonding,
right.
But I don't view the numbers as very crazy.
Okay, no, they're not. But at the same time, you're not getting any credit for them, and they're not earning you money, right? They're not earning you value. You're whatever, it's 8 million market cap at the moment, and no one seems to be paying attention.
That's true. I have a philosophy that I've kind of developed, which is don't tell me what it costs per meter to drill. Tell me how many shares I have to print per meter. And so today, I know it costs me $100 a meter. Well, that means nothing to me. I know it costs me 1,500 shares a meter to drill in Canadian dollars, right? So I know what my dilution factor is. And if you tell me it costs me 1,500 shares a meter to drill, I have to think about that. Do I want to print 7.5 million shares or 10 million shares to drill a 5 or 10,000 meter program? I mean, I can't tell you. I can tell you what I would say because I'm running the company. And no, sometimes there are times I've been in these cycles, and people want us to advance these projects, but it goes back to the whole philosophy of, do you want me to have 500 million shares outstanding? What value am I creating to shareholders, of which I'm the single largest shareholder? Like, what value am I creating to myself if I blow out the share structure, which I can't really go backwards now?
Okay.
Right. So I'm.
But I think we can agree that you're not being credited with the things that you're doing at the moment. So when does the moment arrive? What is the thing that you're going to deliver and the market's going to go, oh, okay, I can see the culmination of what he's been doing since October to date has manifested itself in this one thing. I'm now going to pay attention. So, why should people, what is that moment when people are going to start paying attention to you?
I think there's a lot of things that are going on with Allegiant, much more than other, say, exploration companies. I mean, we do. So we've been focusing on Eastside, and that right now things are moving in parallel in terms of operating permit, geological studies, and we'll release information there. But on a parallel side, we have Bolo, and so Berrien Mining, which we have an earn-in agreement with them. They can earn into 50%. It's 100% owned by us. They have the ability to earn a 50% stake in that by paying us $1 million for the project, plus spending $4 million over the next 4 years. They've spent 500,000, or they need to spend, I believe, close to $1 million Canadian dollars this year to drill Bolo. They drilled last year. It was a very, appears to be very successful program. It carried on what we've done. Now what they're going to do is drill, spend almost $1 million Canadian dollars in drilling. My guess is that'll be a 2,000 to 6,000 meter program in Bolo, and that will have a constant news flow of drill results, mid to end of this year. And Bolo was one of our best projects, but the reality is, my philosophy is you got to focus on one thing, and we chose Eastside because we believe, the potential is very, very large. Bolo could be another amazing project, but we can't do both. And so Berrien has stepped into it.
Okay, so you've taken $1 million from them, plus they're committed to $4 million over the next 3 years, and they've started that process already. So then you've got to hope that they hit something, or at least prove up something meaningful in the next 3 years. And then they've got 50%, and I assume then you that you're not carried on that. Presumably, you're going to have to come up with some money at some point as well, are you?
Well, yeah, they have. So at the end of 2023, they could also elect to go to 70% or 75% of the project by spending an additional X million dollars, and I think it's 4 as well. The reality is they're going to spend about $750,000 US this year. That will get them a lot of drilling. Last year they drilled about 1,800 meters. They spent $500,000 on the program. They released 10 drill results on that. I believe they'll drill at least that this year, probably significantly more. And ultimately that may lead to a resource estimate. But clearly, if they wanted to, they could probably get a resource estimate today.
Okay, and they've got the cash to do this, or are they raising the market as well?
So they, in December, they announced a acquisition of Mount Kinsley from Liberty Gold. So they halted their stock at that time. They're raising the capital as we speak. I can't tell you how it's going. I know how it's going. I just don't think it's my place to say how it's going. And
okay.
We're hopeful that
just nod or shake your head. It's fine. Don't have to say anything.
Look, they're very well represented.
Okay.
People from Liberty have a major interest in the company, and the guy running Berrien has done an amazing job. Okay.
So you got Bolo, and you're saying, again, I'm just trying to piece all this together in terms of help me to understand how you stand out. So you've got some income, irregular income across the year to the tune of about 550. Is that American or Canadian? American. Okay. You've got a bit of cash in the bank at the moment. You're gonna need to raise some money soon, presumably.
Well, I mean, if we want to drill, we have to raise money.
Isn't that how you move things forward?
Well, I think there's a different ways to move forward. Like one Bolo, we're not spending $1, and that we own 100% of that project. That's moving that project forward.
But you're not in control of that. You're out of control there.
No, we're out of control on that because they're spending the money and they're the operator on that. And then on the case of, but it is moving forward, because if they don't move it forward, they would lose the project back to us. Certainly, they have $1 million into the project already. Then, I don't think they're going to walk away for the project that has a discovery that is growing, had a great drill program last year. It was their main project before they acquired Mount Kinsley.
But it may not be their choice. It may not be their choice to walk away if they can't raise money in this market. It may not be their choice, right?
Fair point. On Eastside, for us to continue drilling, the first step we need to do is increasing our operating permit area, and whether we want to drill or not drill, the first step we need to do is increase that area, and we're doing that. And what could change? Well, if the markets opened up today, we would raise money, and we would drill around the original pit area that doesn't require the extended operating pit area. So the extension of the operating, or the expansion of the operating permit area, allows us to go beyond the original pit zone and expand that. So, but what can we do if the markets were to change? Well, we can drill the Castle zone on the south, and we can prove that up and include that in the 43-101 resource in the east side. We could continue to drill within the original pit zone and expand that resource within the original pit, as well as potentially reduce strip in that area. But look, there's other ways to skin the cat here, and we are, I think we're being prudent in how we're managing our shareholder capital and how we look at share count. I mean, you look at our share count, it's been the same for a few years, and I'm very, very proud of that, because not a lot of exploration companies, are going to say that they've had 61 million shares outstanding for 2 years. It just doesn't happen very frequently.
Yeah, but that's not how I make money. I make money when your share price goes up, right? And it hasn't.
But it's fine. So I took over in October. The first thing we did was we cleaned up the share count. We got a hold of it. I bought my own position in there. I cleaned out shareholders or any weekends that were out there, and that's fine. We took the shares off of Gold Corp. So Gold Corp was it did a private placement 2-3 years ago when they merged with Newmont. The first thing they wanted to do, Newmont came out and said, "Look, hey, we're going to get rid of our juniors." They called us, and I was happy to buy their 6 million share position, and I primarily was bought by me. So the first thing I had to do was clean up that share count. And as a shareholder, you want to make money, but you also want to know what the torque is in it for you. Like, I can show you, Matt, a path of, to getting to 100 million market cap, which I think is reasonable. But if I'm going to have 200 million shares outstanding doing that, for you, the upside is 50 cents Canadian, which is only about 35 cents US today. But if I can show you a path of 100 million by keeping the share count down, I think I've done a better job. And look, I can show you, I look at hundreds of junior companies, hundreds, and I won't go into names, but there's some great results that have come out particularly near in Canada, near Ontario recently. Some amazing results, 150 grams for over 8 meters, and the stocks go down. So there is no correlation from work program, at least that I can see, any work spending and advancing the project on drill results and stock price going up. So unless someone shows me where I'm wrong in my belief, then I'll change it. I just think today you have to choose your timing. And I think I'm doing more of a service to an investor by being prudent, doing things that don't cost a lot of money today, because the market won't care or may not care. Like we published an excellent, I would say an amazing updated resource that increased resources by 55% by adding resources through additional drilling and obviously higher gold prices. Slightly reduced strip, kept grade the same. It almost on every aspect was great, and the stock did nothing. Okay, so
yeah, that was the market for the last year and a half. No one cared.
But that's my point, Matt. And so when you push back at me and say, well, look, we got to get the stock. How am I going to make money? Well, let me tell you, I can push all I want, but if the market is not ready from a timing perspective to go up, the best thing I can do from an investor is protect the capital, protect the share structure, because when it turns, Allegiant may actually be the best company position from a price per share perspective. It may give you the best torque. It may not give you the biggest market cap, but there's a lot of companies that are going to go up to $200 million in market cap, but I may have 1 billion shares outstanding. I don't think I'm doing a service to the investor because of that. And I'm the largest shareholder. Insiders are very, very large shareholders of the company. And I have this discussion with our board all the time. And I have the support of the board to give that, upside potential to investors.
Fantastic. Yeah, 14.5%. Yourself and insiders at the moment. And so you're paying yourself, or are you just doing this for free?
No, I pay myself a very small salary. I don't remember if it's around 6,500 a month, 7,000 US a month. It's in the public records, but it's reasonable.
But
The Canadian dollar, I would think that our cost structure is actually down, but through currency more than anything, translated to US dollars. But I want to make money by the share price going up. So back to your comment. Well, there's no one that's more incentivized and motivated in getting the share price up than me. No one, actually, no one. So I want to protect the share count. I'm not interested in increasing market cap. I'm interested in increasing price per share.
okay, beautiful. Got the message loud and clear. Let's wrap it up there, because that's a fantastic first introduction to, it's a small exploration business, but I'm always interested in seeing how people are going to try and stand out from the marketplace. You're putting it down to timing. So last question of the day is, what do you think that timing is going to be given market conditions as you see them now? I know it's slightly strange times, but can you put a pin in it?
I can't. I'm not a market timer. What I can tell you is that when I got involved in mining companies back in 1997, 1998, when I was at Solomon Brothers, and when I first made my first personal investment in 2004, I think gold was around $400 an ounce, $450 an ounce. So another of my quirky ratios that I look at, so I have shares per meter and all of these other things. I also look at what the value of in situ resources are as a percentage of spot price. So back then, let's say a company was valued at $10 an ounce, and that was one of the bottoms of the market in the junior companies. But they were valued at about $10 an inferred ounce in situ. But gold was 400, right? So that basically gave you essentially about a 2.5% of spot price. In 2007, a lot of these companies, I don't have the actual statistic, but $100 an ounce was common. The gold price was about 700. And so it turned out to be roughly 14%, 14.5% per of spot in situ resources. Okay. Today, many of the juniors are being valued at $10 an ounce, but gold is 1,600. So that gives you 0.6% of spot price. So I don't know what the timing is like, but if gold prices stayed where they were and the market were to revalue the exploration companies, the companies actually have resources, to $100 an ounce again from 10, well, that's a 1,000% run on it, and it still would be historically cheap. So put that in context, 100 of 1,600 would be about 6.5%. It would be historically within the average, but on the lower side. So to answer your question, I don't have a crystal ball. I don't know when the markets are going to turn in the exploration. They are cheap. Time is maybe on our side if you're not burning through cash, and you just have to wait it out. And I wish I could give you a better answer. I just don't know.
Thanks, Peter. Enjoyed that
All right,
chat.
thank you.
Stay in touch. Let us know how you're getting on, with obviously the markets as they are. Maybe, who knows when that will be, but we'd love to hear from you as you progress things. I appreciate your time today. Thank you.
Thank you, Matt. Take care. Cheers. Bye-bye.